Hey everyone, and welcome back to the show. Sometimes you hear stories about prodigies, right? But what if I told you about a 14-year-old kid, barely out of middle school, who basically cracked the code on stock prices so effectively that he didn't just make a fortune, he made and lost over $100 million, not once, but multiple times in his lifetime. I mean, talk about a roller coaster.
And honestly, the craziest part about this whole story to me is that his strategies, developed over a century ago, are still incredibly relevant. Traders are literally using his methods right now, today, to bank some serious profits in the market. It's wild.
Absolutely mind-blowing. So today, we're not just chatting about some historical figure. We're actually breaking down Jesse Livermore's exact trading playbook. And when I say exact, I mean we're skipping the fluffy motivational stuff. We're getting right into the actual mechanics, the nitty-gritty details he used to become one of the greatest speculators who ever lived.
And trust me, you'll want to stick around for this whole conversation, because at the very end, we're going to reveal the one rule that literally saved him from total destruction every single time he actually followed it. Most traders, frankly, completely ignore this, and it costs them dearly.
All right, let's dive straight in. The absolute foundation of everything Livermore did, his entire approach, comes down to one core concept, what he called pivotal points. Can you break that down for us?
So what exactly is a pivotal point? Think of it like this. Imagine a pressure cooker. A stock trades sideways, right? It's moving in a relatively tight range, just building tension, building up all this energy. Then suddenly, boom, it breaks out of that range. That specific breakout level, that for Livermore was your pivotal point. It's where the energy finally gets released.
And here's what so many people miss, the beginner's trap. Livermore didn't just buy any breakout. He was super selective. He waited for the longest consolidations. Why was that so important to him?
Because the longer a stock stayed coiled in that tight range, the more explosive the move was going to be when it finally broke out. It's like winding a spring tighter and tighter. He wanted maximum potential energy. And here's the kicker. Volume was his absolute confirmation. On the breakout day, volume had to spike, significantly higher than average. If the stock broke out on weak volume, he passed. No exceptions, no debate, he just didn't touch it.
Okay, so we've got the breakout with strong volume. Now this is where it gets really tactical. After that initial surge, Livermore actually expected what he termed a normal reaction. What exactly did he mean by that?
A normal reaction is basically a healthy pullback. After a big move, some profit taking is natural. And during that pullback, here's the critical part. Volume needed to decrease significantly. That told him the selling was just short-term profit taking, not a fundamental shift in demand. It meant the sellers were weak and the overall move was still healthy, still intact.
Right. So if the stock then resumed moving in the original breakout direction, with volume picking back up, that's when he knew he was really in the right trade. It's like the market giving you a second confirmation, isn't it?
Exactly. Let me ask you this. Have you ever bought a breakout, watched it pull back, panicked, and sold, only to watch it rip much, much higher without you? It's a common, painful experience for so many traders.
Oh, absolutely. Classic mistake. Livermore completely understood that these pullbacks after breakouts are normal. They're part of the process. The key, as you said, is watching the volume behavior during that pullback, not just the price alone. That's the secret sauce.
Okay, let's move on to the next principle, and this one seriously is huge, probably one of the most impactful. Trade only the leaders.
Livermore, from what I understand, was almost obsessed with leading stocks. He believed they held a deeper secret about the market, right?
He absolutely did. He said the strongest stocks in the strongest sectors literally telegraph where the entire market wants to go. He even famously said, go with the most powerful stock in the group. Don't look for the bargain, the weak sister. Go with the leader, the anchor, the strongest stock in the group. It's pretty direct, isn't it?
Super direct. So effectively, forget about bargain hunting, forget about trying to find the next hidden gem that's undervalued. Livermore's philosophy was that the leaders lead for a reason. They break out first, they hit new highs first, and crucially, they give you the clearest, most unambiguous signals.
And here's a practical filter you can use today, right now. Look for stocks with the highest 3-month relative strength. That's your modern-day equivalent of identifying those market leaders. They're telling you where the money is flowing.
Okay, let's switch gears and talk about the rule that, frankly, separates the pros from the amateurs: position sizing and pyramiding. This is where a lot of people go wrong, right?
Oh, absolutely. Livermore never, ever went all in on day one. Never. He would probe the market with a small initial position, almost like testing the waters. If the trade then moved in his favor, then he'd add more. If it didn't, his loss was minimal, just a small bite out of his capital.
And this technique is called pyramiding up. You're only adding to winning positions, never to losers. That feels incredibly counterintuitive for a lot of people, doesn't it?
It completely is. He actually said, never average down. Continue to buy more shares only when the stock price continues to rise. Think about that for a second. Most traders do the exact opposite. They buy more as a stock falls, trying to lower their average cost. They're essentially adding to a losing bet.
And that, my friends, is exactly how most traders completely blow up their accounts, trying to catch a falling knife with more money.
Livermore's approach was starkly different. If you're wrong, get out fast. Accept the small loss. If you're right, let it ride and add to it as it continues to prove itself. Simple but incredibly powerful.
Speaking of getting out fast, this brings us to what he famously called the 10% rule. This was practically his golden commandment, wasn't it?
It was non-negotiable for Livermore. If a trade moved against him by 10% from his entry point, he was out, period. No hoping, no praying, no waiting for a miracle. He cut it instantly. He called this his single most important rule: capital protection above everything else.
Because here's the brutal math, right? If you lose 50% of your account, you need a 100% gain just to break even. But if you religiously cut losses at 10%, you're still very much in the game, ready for the next opportunity. It's truly a game changer.
Now, let's talk about specific patterns Livermore used to time his entries. First up, the one-day bullish reversal. This is a classic.
So how does that look on a chart? Can you paint a picture for us?
Here's the setup. Today's candle makes a lower low than yesterday's, right? It looks really weak, like it's going to tumble. But then it surprises everyone and closes higher than yesterday's close. And critically, this happens with higher than average volume. That's your tell.
So it's a shakeout, essentially. Weak hands get stopped out, they panic and sell, and then the smart money, the institutions, they swoop in and reverse the stock higher. It's a fantastic psychological play.
Exactly. You see this a lot at those pivotal points we talked about, often after a healthy pullback. It's a strong sign that the sellers are exhausted and the tide is turning.
Another entry Livermore loved, which also plays on market psychology, was the gap down reversal.
Yeah, this one's brilliant. The stock gaps down big at the open, right? It looks absolutely terrible, like it's destined to crash. Everyone's panicking. But then, through the day, it recovers strongly and closes near its highs, often even positive. These moves are explicitly designed to shake out retail traders before the real move begins. The intention is to knock out all those stop-loss orders placed under key support levels.
And if you see this kind of reversal happen on below average volume, even better, right?
Absolutely. It confirms that the selling pressure was more artificial, more fear-driven, rather than a genuine shift in fundamentals or institutional selling. It's like a head fake by the market.
Now, this next point is probably the hardest for most modern traders, especially with all the noise out there. Livermore talked a lot about when not to trade. He famously said good timing might only appear 4 or 5 times a year.
4 or 5 times a year. Just let that sink in for a minute. Most traders out there are clicking buy and sell every single day, sometimes multiple times a day. It's a completely different mindset.
He truly believed that. He actually said if you don't let go of every trading day and speculate every day, it will be impossible to succeed. He also noted, money cannot consistently be made by trading every day or every week during the year. He saw overtrading as a direct path to ruin.
His entire fortune, his entire success story was built on patience. Conversely, his periods of losing everything were often tied directly to overtrading, trying to force trades when the market wasn't offering clear opportunities.
So we've talked about getting in. What about the exit strategy? Livermore watched for what he called abnormal behavior. What did that look like for him?
It's the flip side of normal reaction. The same way he looked for healthy pullbacks after breakouts, he watched for when the stock simply stopped acting right. Maybe volume spikes, but the price doesn't move much, indicating selling pressure. Or maybe the stock repeatedly fails at a key resistance level it should have broken through easily. If there are any noticeable deviations from the expected breakout pattern, any red flags, it's a strong sign that the pattern is likely to fail, or the trend is weakening.
And abnormal behavior meant one thing for Jesse Livermore: time to take profits, then step aside. Don't get greedy, don't overstay your welcome.
Exactly. And this leads perfectly into his most famous quote about holding winners. It was never my thinking that made the big money for me. It was always my sitting. That's profound, isn't it?
Oh, it's incredibly profound. The big money, the real money, is made in the big swing, in catching that entire trend. Not by scalping in and out, not by taking quick profits when a trade starts to look good. It's about sitting through the inevitable noise and letting the trend, the market itself, do the heavy lifting for you.
One more critical rule from Livermore, and this is pure financial hygiene. Always keep cash reserves. He actually said to set aside half of your profits as reserves. Don't reinvest everything.
That's brilliant, because with robust cash reserves, you won't go bankrupt during tough times. And crucially, you'll have capital ready and waiting when market conditions inevitably reverse and new, clear opportunities appear. Cash gives you the power to capitalize when others are licking their wounds.
So let's do a quick recap of Jesse Livermore's timeless playbook. Number 1, wait for pivotal point breakouts with strong volume confirmation.
Number 2, trade only the leading stocks in the strongest sectors. Don't chase the laggards.
Number 3, probe with small initial positions and only add to those positions when you're actually right and the trade is moving in your favor.
Number 4, never ever average down and cut your losses ruthlessly at 10% maximum. Protect that capital.
Number 5, don't trade every day. Be patient. Wait for the clearest, highest probability opportunities, maybe only 4 or 5 times a year.
Number 6, exit your trades when the stock starts showing any kind of abnormal